Hello, everybody. I'm going to start here today. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell any securities, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading securities. MetaStock, Traders Forum LLC, and their employees and their guest speakers disclaim all liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the companies. MetaStock, the Traders Forum LLC, their employees and guest speakers do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation should be construed as investment advice or the solicitation to buy a security. All right. Hello, Diana. Thank you for saying hi. We started that a little bit differently because that's the cut point. We're going to, when we do the video and put it up on YouTube, well, I guess the cut point is going to be right after here. We'll just put in a disclaimer and then go from here. So with that being said, welcome to the event today. It's good to have you. My name is Jeff Gibby. I work with MetaStock, and I've got the very lovely, a good friend of mine, Anne Marie Baind here. You can find Anmarie at thetradingbook.com, and you can also follow her at Anmarie Trades. Anmarie has done 4 events with us now. So Anmarie, it's good to have you on here. I always love having you on here. You're actually one of our most requested guests. And I think the reason is you have a lot of depth to you. You have a lot of information, and you have a way of saying it very, very interestingly. So,
well, thank you. I appreciate that.
All right. And just for everybody, there's a little bit of a commercial, but if you want to watch this live, if you want to join the community, you can. Thetradersforum.com. You can chat with traders. You can learn about the markets. It's a community of traders helping traders. So without further ado, Anne-Marie, let's get into it. How are you doing?
I'm doing really well. The market is finally doing things that I think are subnormal, at least a little bit, instead of running straight up every day. So it's been nice to see a little bit of normal rotation.
I like the fact that you start immediately there, because that's where I wanted to start too. So when you say subnormal, do you think the correction we've had so far this week has been a buy the dip moment, or do you think this is a structural change? How do you see it?
That is a great question. And so the answer to that, easily said, is what I try to do is look for clues in the market that tell me something might be different. So last week, Friday, we had the savage sell-off, but we've had big sell-offs. But when we look at the heat map that gives us, are we red in certain parts, green in certain parts from sectors or whatever, we notice that money has moved from one place to another and then moves back. And of course, everybody's in tech and the like. But what I noticed on that Friday of last week is that we had very large volume. And we had that volume during parts of the day that we don't normally see that kind of volume. And so it came after 10:30 and 11 o'clock and 12 o'clock, where the market normally gets quiet. It's the lunch lull, right? Sometimes we call it Death Valley as an intraday trader because it just settles out flatly. But what we noticed was a lot of volume going in there. And then when I went to the heat maps, everything started correlating. So it looked like everything was coming out of the market. And so that is a de-risking rather than a deleveraging. So the deleveraging, maybe you trim some gains in one area, add to another area, but this was a pretty solid sell-off. And so that made me say, okay, I am not going to buy any dips on this coming Monday. And if you'll notice, Monday, Tuesday, Wednesday, and today, with the exception of this great big newsy kind of thing that came in at around, let's see what time that was, came in around 1:30 and the market, maybe 1:15, and the market just exploded to the upside. I don't know if it's news, but whatever it was, it forced price action higher. And now we're sitting right at the closing area of Friday's gigantic volume event. And so today is the first day where I've said, if we can come in tomorrow and trade above these levels, we've got ourselves some bullish price action that we can follow through on. But right now, every single big bounce, I am selling. And so my thought actually today is that into the close, I want to sell some stuff. I think I'm going to sell some SPY. I'm going to sell some SPY.
Okay. Let me ask you this. You say that it happened at an unusual time.
Yes.
Do you think that's significant, and why?
I do think it's significant. It's significant because it happened when it doesn't normally occur. That's the only why I can gel together. The what that made it happen, I have no idea.
Okay.
But what I do see is motion that gives me some pause, because we continue to make lower highs and lower lows, right? And since Monday, since actually last week, Friday, we've made lower highs and lower lows, and lower highs and lower lows. And as you know, Charles Dow defined trend by a series of lower highs and lower lows, or higher highs and higher lows.
So right now, it sounds like you just said sell the SPY.
Yeah.
What are you watching for to kind of change your opinion?
That's another fantastic question. What I want to see tomorrow is if the SPY can get up over, and let me double check on this level. I want to see that the SPY can stay up over 737.
Okay.
If it does, it's telling me a different story. It's saying, hey, listen, the buyers are really trying to put a foothold on. So the question might be, well, Anne-Marie, if you buy the SPY, if you sell the SPY here and it gaps up tomorrow, won't you be upside down in a trade? So what I will normally do is go far outside of the money to maybe 750, and I will sell a call spread, meaning I will sell the 750 and buy the 755, and maybe I'll give it a week to work itself out. So if it does gap up tomorrow, I'm not holding the bag from just being, short just because I'm feeling it.
Mm-hmm. Okay. Very cool. Let's see. That was a good overview of the market. I appreciate that.
Yeah.
Do you a lot of the theory behind the catalyst as to why the market dropped had to do with inflation? Do you think that's a major player with it, or do you think it's a larger issue, or are there other things at play, or are you just watching the chart, which is always an easy answer?
Yes. And so I will tell you a little secret. I do not listen to the news until after the fact as a review. What I have a tendency to look at is the big picture. So for instance, let's say you run an institutional desk and you have a portfolio that, you're running $5 billion. Not a lot in today's market, but enough for you to be looking and actively positioning. Are you going to see an inflation number that immediately makes you go, oh, I got to sell, or, oh, I got to buy? The answer to that is no. What you're going to do is say, isn't that interesting? Let's see how I'm positioned for risk based on what happens according to these numbers. So what it really tells you is that institutional traders are much more discerning about where they move money and how they move money, because one, it costs a lot of money to move billions of dollars of stock, number one. Number two, you don't want to move in and out because your portfolio is going to have a bit of bleed because you've got all these charges for trades. So my first year of trading, I did not realize that. And I did not put it in my mind. And I spent, I think the number is like about $78,000 in fees, in trading fees in 1 year. And so imagine multiplying that by billions of dollars. I mean, they might get it on the cheap, but they're not going to get it that cheap. So the bottom line is institutional traders only move the market when they're ready to. And because they are generally long, what they're going to do is when a chart starts moving very high, and let's say you start with part of your portfolio and 10% is NVIDIA. Let's say it's very concentrated, 10% of NVIDIA. But NVIDIA moves so far, so fast that it becomes 15%. What are you going to do? You have to sell part of that off.
Right.
Yeah, you have to sell part of that off to keep your balance in check. So some of it goes to cash so that you can buy either something else or you can buy more NVIDIA when it pulls back into an area. So institutional money is prepared to sell when they need to sell, but they don't normally need to sell. So this motion here was caused by the amplification of zero-DTEs. I don't know if your group is super familiar with trading with zero-DTEs, but the 0 days to expiration contracts become very amplified in the following way. Let's say I'm a market maker. So what a market maker does is he doesn't care if you are long or if Jenny over there is short. He doesn't care. He takes your trades, you come to him and you go, hey, I want to buy 1,000 SPX contracts and I want to do it today. He will, or I will, sell them to you. Now I'm short 1,000 SPX contracts. So what am I going to do so that I don't lose a ton of money? I'm going to go out and I'm going to buy the SPX. So what's in my basket is neutral. And so that neutral space is what keeps market makers in business. And they make a little bit of money off of the transaction between the buyers and the sellers. But their goal is to have enough of them on both sides that they're doing okay. So you come in on Friday morning and you come to me and I'm the market maker and you go, hey, listen, I want to buy 1,000 SPX puts. So I'm now short those puts, meaning I'm bullish, and you're long the puts. You're going to win if the market goes down. You're going to make a lot of money. So let's say the market starts going down. What will I have to do to fix my book? I have to go out and sell the SPX because I am short the puts, and that's bullish, but the SPX is going down, and so that's bearish, so I have to go sell the SPX. Now think about lots of market makers doing that, running their books, and lots of trade desks running the market books like that. Once the price action starts fading, they have to sell it. So it becomes very aggressive in the sell point. It's sort of like rolling that Sisyphus stone off the top of the hill and watching it go down. It's going to move faster and faster and faster as it gets to terminal velocity. And then, it's going to wipe out everybody in the space. But at some point into the close of the day, you decide, oh my gosh, I've made a ton of money today. And you come back to me and you go, hey, I need to sell those puts. And of course, I'm going to go, thank you very much. I'm going to buy them back. That's going to flatten my book. Now that my book is flat of the options, now I got to go unwind all the stock that I have. I have to go buy it back into the market. And so those two pieces of you coming in, selling your puts, making all your money on the end of the day, and me going, holy cow, I've got all this SPX stock. I have got to buy it back. That's why you see the market turned around and aggressively starts trying to catch a bid. I know. What did I take 9 minutes doing that? I am
That's
so
amazing,
sorry.
though. Like, I just love the idea and the concept of the margin amplification. And
Yes.
you think about not just the Zero-DTE, but all the ETFs, all the leverage,
Yes.
the amount of
Yes.
the economy that's gotten to the point where we're so leveraged.
Yes.
And it feels like it hasn't. We got pretty leveraged right before the 2000 housing crisis, right?
Yeah.
But it feels like we're way past that.
Oh, way past it. Yeah.
Do you think there's going to be a reckoning at some point?
I'm going to say absolutely there will be a reckoning.
An unwinding,
Absolutely.
yeah.
There's going to be. The question is how and when. And then as traders, we go, okay, well, I know that's going to happen. But if we talk to a lot of very big money managers and folks that are at the top of the houses like Schwab that deal with retail and the standard investor, we end up losing a lot more money betting on things going down than we do making money on things going up, because disaster is just a great sell point. So we run out and we buy insurance that is very expensive, and then it ends up expiring worthless, and we're out of luck. So what you have to be as a trader is to say, okay, what just happened? All right, Friday, we had this giant sell off. We had tons of volume rolling through the day. We know what's happening with the market makers and having to unwind. And that's why we bounced into the afternoon. So we understand this is a big event, but potentially not the event. So the question is going to be, when do I stop making lower lows? And that's going to be the thing that tells you, hey, I'm bouncing really high, but I'm still coming back and making lower lows. I got to stop doing that. And so as long as I bounce and roll over, I'm going to have more short side formation. And so you as a trader might be saying, I need to be a little bit careful about where I'm buying right now, because the low might not be in. Now, here's the thing. We're in a midterm cycle. And statistically speaking, midterm cycles get very hot and bullish towards October, November, December. We will normally have a fade into summer and the lulls of the summer. But by the time December rolls around, the broad markets are back to positive. So to me, that says, okay, I need to get my shopping list out. I need to do my scans in MetaStock. I need to start looking at price points and watching for my lows to come in and seeing responsive buyers. So what is a responsive buyer? That's somebody who has told their broker or told their trade desk, listen, anytime this comes into $200, I want you to buy. I want you to hit that bid and go collect me some stock. I want to end up having 50,000 shares by the end of the month. Go to it. And so when you see that, what'll happen is it'll come in, it might break a little below, but then it recovers. So a lot of times we watch things and we go, oh my gosh, it just broke my level. And we stop looking at it. We either get stopped out, we're disgusted, we turn around and whatever. But how many times have we done that? And then we come back like 3 weeks later and it's recovered completely and we just are so mad we want to chew some nails. I know it's happened to me.
It's happened
a fair bit. Yeah. And so what that's taught me is, okay, it failed today. Let's put an alert on that and let's take a look at it next week, see where it's going.
Here's another thing that I want to just bring up. I think it's a little bit of a pink elephant in the room. And
Not
It has to
just
do
an elephant, but a pink one.
Oh, pink one. Well, they're the best color. But the World Bank just issued a grim warning. They were talking about the global economic fallout from the Middle East. They're talking about the worst supply shock we've seen since COVID. Do you feel like do you feel like the lack of an end to hostilities in the Middle East is going to have an impact in the market? And how would that be felt if it does?
Okay, so statistically speaking, and we are not involved in many skirmishes on the front line when it comes to the Middle East. So this is a little bit of an aberration. But statistically speaking, there is so much discord in that part of the world that we usually ignore it after a while, and the markets just continue on their way. Now, what we have here is a pathway in the Strait of Hormuz that is blocked largely because of the disruption. Now, if you say, hey, we're having just global repercussions of all of this happening with oil and whatever, so oil should be going higher, right?
Mm-hmm.
You'd think.
Yeah.
Oil's not going higher. It hasn't. Oil is literally sitting in the same candlestick formation as the week that we got into the altercation with Iran, the same week. And so there are two warring factions in the energy space right now. It's very mystifying. The guys who really work with, let me see what supply chain looks like, let me see what's going on here, how much do we have in reserve, what are we doing? All of those guys are saying, man, oh man, we've got a storm coming because we are just not getting enough oil to everyone else. The other side is saying, we got nothing to worry about. We become the net exporter, the US, the net grand exporter. We've overtaken Iran for exporting to India. India gets more oil from us than they do Iran now because that has been shut down, and Modi would like to keep the relationship on the plain ice board. And so we're getting a bunch of oil from India is getting a bunch of oil from the United States. The problem is we can only pull light, sweet crude out of the ground.
Right.
If you drive a diesel vehicle of any kind, and folks, the reason diesel fuel is so big is because it's the only fuel that gives us the power of combustion that big machines can run on.
Right. It's how we move everything around America.
Exactly. That's why if we look at the trucking numbers from the West Coast to the East Coast, trucking, the last thing that I saw said trucking fees have gone up 36 cents per mile. You might think to yourself, well, 36 cents, that's not too bad. But they're paying $12 for diesel in some spaces. So there's going to be a rubber meeting the road in some space. That's why we're trying to make nice with Canada, and we're trying to do something with Venezuela because they have heavy sour, and we need to mix it in order to get that sort of space. So we've got a lot of the light, sweet crude stuff, a lot of gasoline, but nothing to run big trucking things. And so there's a problem there. But obviously, like this big warning about this global disruption, I'll pull out my tinfoil hat. I have one. I have many, all different colors.
Yeah.
All different colors, tinfoil hats. So my tinfoil hat there says, my tinfoil hat says, hey, listen, we want to make sure that the world realizes that we've got some kind of disruption, but because it's the World Economic Forum or the whomever, that's saying that, it's always going to point a picture to the United States and say, you guys are terrible at playing in the sandbox together, which is, you know, our current commander in chief is not great at playing with people in the sandbox. We can leave that there. But the big picture is they are the ones having more trouble than we are. If you buy, it's 4.3 liters to a gallon of gasoline in the UK. It is $16 a gallon in the UK and in Europe. So they are doing terribly. A lot of people go, oh, Iran is going to be fine. Listen, their people are so fractured. The rich are doing really fine, and then the middle class to the poor are, I mean, they don't have fuel for light. They don't have fuel to get to work. They don't have fuel to open up their stores and their markets. It is in a dreadful space. So, I mean, I don't know what's going to happen tonight. They're warning of all kinds of, you know, bad things going to happen, and the market's going straight up. Then nobody cares. So this is my thought about saying, hey, at the end of the day, Middle East events are, yeah, that stinks that that's happening, but oh well, let's move on. And so ultimately, I think that's what eventually happens.
I think it's funny that you brought up the bifurcated economy of Iran. And we had talked about the bifurcated economy of the U.S. back where we talked about that.
Yeah.
And you had talked about the heavily bifurcated, the rich buying Bentleys versus the poor struggling and the middle class shrinking. How is this being reflected in sector report performance? Is this still a thing that you see happening strongly here in the U.S.? And is that affecting different sectors differently?
So wow, these questions are great. So first things first, we had the CPI and then we had the PPI. CPI was cooling a little, PPI a little bit hotter today. And so we have to remember that these numbers are ex food and energy. So what does that mean? It does not count the prices of food and the price of fuel. Now,
the two things that are going way up right now.
Exactly.
Right.
Exactly. And so the lower income household spends more than 50% of what they pull in for food and transport. And as that continues to rise, I don't see that it's getting any better per se. We have seen housing prices come in, but we just have got to learn to build houses a different way. In Europe and the UK, I mean, these things are built by machines, literally CNC machines, just cut out the boxes and go, okay, here you go. And we still have guys doing all kinds of crazy, putting a house up, and it makes it much more expensive. We've got to bring the price of new housing down so it can be affordable to others. That's number two. Rents are coming in a little bit, but the squeeze is food and energy still continuing to rise. And if we don't really force energy down somehow, either with more natural gas or more alternative energies or uranium or, you know, I know people freak out over nuclear energy. It's really, the things that have happened were because people didn't pay attention, and they should have. So maybe we learn our lessons. But in any case, yeah, I believe it's still bifurcated as ever. I believe it's reaching up a little bit more. And here's an interesting thought. Now that the pattern day trading rule is down, a lot of people, more people own stocks and options than have ever owned stocks and options ever. So we're reaching a broad swath of retail. The problem is, because there's no barrier to entry, nobody knows how to manage risk. I certainly didn't when I first came in, and I thought I could manage risk, but I did not have a clue what I was doing, and I lost a ton of money. And so folks rushing in that are young retail traders, they're thinking this is their only way out. There's no way I'm going to get a job that's going to make me 300 grand. I'm not 500 grand. I'm not going to be an influencer anywhere or whatever it is that they're thinking. They go, the market is my slot machine. And so those of us who've been around for a while, we go, yeah, sometimes that slot machine can reach right out of there and bite you. So that's going to be very, very interesting unfolding altogether. But I see the disenfranchised even being more disenfranchised, and the more a narrative is placed to folks and people go, yeah, I don't believe you, which happens from distrust. And a lot of us have seen trust broken in our leadership across the board. And so, that foments disruption. And I think we continue to see it. I really, really do.
You said something and it kind of made me think of something. So I'm going to talk about a little bit of it. One of the things I heard early on, and I don't know who to attribute this. I would if I did. But they were talking about like the best time to kind of start to get bearish about the markets is when your taxi driver is telling you what stocks to buy. Now, we live in a different world now. It's going to be your Uber driver, but do you feel like the fact that there's a lot of retail involvement in trade might be indicative of something to come?
So what's super interesting, a long time ago, retail used to be called dumb money, and which I always resented because I'm not dumb.
Come on.
Yeah, come on. So what I am is maybe not particularly versed in how to manage risk at the particular time. And so what we've noticed, if we take a look at where the run-ups have been, the smart retail traders have been able to catch these moves and watch them move up. I mean, Micron going from $250 to $1,000 or $1,100, wherever it was, in just a very short period of time. There are some people that rode that all the way up and then had just decided to go, okay, now it's time for me to close. So there are some very savvy retail traders out now, but what we are is bombarded by news. And so literally, you must be living under a rock if you don't know SpaceX is going to IPO tomorrow. And I mean, from the guy delivering my food, the guy delivering my food to somebody at the checkout when I pay for my fuel. This SpaceX is going public tomorrow. So the hype of this one has me very nervous. Have you ever seen hype like this?
No.
I have never.
I'm glad you started to talk about SpaceX because I would have been definitely remiss if I didn't bring it up. So yeah, no, the hype is insane. The hype. What do you feel about them changing the rules so that they could put it in the NASDAQ 100 earlier?
That I feel is so. I don't know. I don't think it's a good idea because it hasn't proven itself out.
It has
Now, yeah, exactly.
Right.
And so that's why we have the 120-day anyway, right? We have this space where we go, hey, you're committed to holding it and blah, 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 blah. And then the lockout period ends, it falls off a cliff. I mean, you remember Facebook it went down to nothing and then all of a sudden got revived maybe a year later or whatever. But after the lockout, it really fell like a stone. And so now we have this 3-week event where it has to go into the NASDAQ, and then every ETF that models the NASDAQ is now going to have to buy some. And so there's a forced buying event. And I think BlackRock said that they were going to reserve $4 billion to add to SpaceX if they were I think they're saying, hey, we're going to put a floor under that if we could talk about that sort of thing. So I think it's a very bad rule to do it for one company. But, Elon has love him or hate him, and I really am quite ambivalent about Elon. I mean, maybe I'm more indifferent than ambivalent. No, I think I'm ambivalent. So I have good things about him, bad things about him. But at the end of the day, I'm like, yeah, he's just another human being that's doing what it is that he thinks he needs to do for himself. But there's this hype around him that you either really want him to succeed or you really want him to fail. And that's just sort of the flag that you planted. And, come what may, I'm going to be on team Elon or team not Elon. So it's disturbing to me, but I don't want to sound like a boomer, even though I am a boomer. Yes, folks, I am. Barely a boomer, but I am one. So it concerns me. I am not going to buy SpaceX. I am going to look at
You are going to watch them.
I am. I am going to watch it. And I think it's probably going to be late. So maybe it'll come out at 11 or something like that. It won't come out when the market opens up, maybe. But I want to look at SpaceX's suppliers. And those guys have been really running like a rocket ship. No pun intended. And so when they, like for Velo, VELO, they actually make the Falcon rocket, but they 3D print it. I had no idea. And so it's an incredible company and just doing really well and just has rocketed up. So the question is, can we watch it come down, get a higher base, and then start moving in? Tesla, everybody's talking about Tesla and SpaceX eventually merging. I don't even know if that's going to be a yes or no. We know Tesla is going to only have a certain portion for cars. Everything else is moving into robotics. And so, maybe that's who he's going to send into space to populate Mars for us. I mean, us figuratively. I'll be watching him from planet Earth.
You're not going to be on the first trip, huh?
No, or the 10th. Or the 50th. Yes.
Or any of them.
Yeah. No bueno for me.
Is I'm not going to buy SpaceX a hard rule for you? Or is it I'm going to wait?
I'm not going to buy it. Yes. I'm not going to buy it tomorrow.
What are you thinking is kind of like a seasoning period for you? Like, is it something you consider in a week? 2 weeks?
I feel like this new 3-week rule is going to be a big tell, but I don't know if it's going to fuel the fire to the north or throw water on the fire. Okay. And so I'm willing to wait. So the question might be, yeah, Marie, but good things come to those who wait, but only what's left over from those who hustle, as Abraham Lincoln said, or at least Abraham Lincoln was supposed to have said that. So what would I do there? I would sell a put. I would sell a cash secured put, and I would say, listen, if it comes back into that price, I will take hold of the stock. But if it doesn't, I get to keep the cash that was sitting there anyway. And so I'm going to wait for the dust to settle. I've never been an IPO buyer. It's just not, it's not my wheelhouse. I move too slowly for that, I think. Yeah.
Yeah, me neither. Me either. When we talked before, and this kind of goes back a little bit, but you had talked a little bit about the importance of credit spreads.
Yes.
While we were grinding higher in January. I wanted to check in on you to what you're seeing now with credit spreads, now that we're about 6 months in.
Yes, very interestingly, spreads are just as tight. We don't see any equity disturbances in general spreads. High yield spreads are still fairly tight. They have not moved at all. And so, to refresh everyone, when a spread is wide, it's the guy in the middle who has to take the risk. Remember, it's the market maker that facilitates the motion of what's going on. And so, if the spreads widen, it means that big pocket of risk happens for me if I'm the market maker and you go, hey, I want to buy that, so I have to sell it to you. Now all of a sudden I am short, but I collected a good amount from you. Now I need somebody else to buy it from me so I can sell it to someone else and get the risk off of my books. And when that spread gets wide, it gives me the money I need just in case things go sideways, right? So when the spreads tighten, it means trouble and bigger risk. And so the spreads have stayed tight. Interestingly, just this past week, institutional spreads have gotten a little wider. So is this something that's got to be something going on with the overnight? What is that happening? I don't know. This is where I go, all right, I'm going to watch this and see next week if we see more private equity stuff, sort of, cockroach comes out of the woodwork. If it's not private equity that's fairly illiquid, they've stopped redemptions. We know that. They've said, hey, you can't have any of your money left. But when you sign the paper to make the money that you're going to make in private equity, they tell you, hey, you can't get this if you want it. And just tough nuggies for you. You're going to have to tough it out and wait. And so they're through that. But people are thinking that we're going to see some more bankruptcies on the rise. And actually, just this past month, we have an increase in overall businesses filing bankruptcies. But it has not shifted the spreads very much at all. Maybe because they've all divided the risk between everybody. I don't know if you've seen how they chop these portfolios up. They'll, like let's say you want to build the next Burj Khalifa. There's at least 35 banks and 200 other little things that go, okay, you get, this is your risk, this is your risk, they just chop it up everywhere so the risk gets spread around and, one big guy is not on the hook. The old saying goes, if you owe the bank $1,000, that's your problem. But if you owe the bank $100 million, that's the bank's problem. Right? So that's what they try to do, spread this risk around. And so far, private equity is not, it's not widening risk.
You talked a little bit about the higher default rates of banks and companies. I saw a study the other day that was talking about how high income earners, particularly people making six figures or more, are defaulting at higher rates than they've seen previously. Mm-hmm. Do you feel that says anything about the overall economy?
Well, I think it says a lot about us as consumers because our saving rates are at the lowest they've been since the early 2000s.
Okay.
And because we are a consumer-driven nation, think about it. Every single thing, somebody's trying to get you to buy something. Just, you got to buy this shirt. You got to buy this car. You got to buy this book. You got to buy. So everything is about consumption, everything. And so these folks that are making six figures, and it's different if you're making 990,000 six figures versus 105,000 six figures.
Yeah, there's right? A bit of a scale difference.
Yeah, there's a little bit of but what we do know is that the ones on the smaller edge of that scale, actually everybody in that big pocket, they're reachers. They're always buying more so they can be better, look better. There's a big chase of the dream. I was caught up in that for a long time before I went, yeah, I can't take any of that with me, and it's not going to do
You don't
any
care
good.
if you're the richest person in the graveyard.
Exactly.
No, me neither.
Exactly. Yeah. Yeah.
Talking about things that you want to buy,
Yeah.
kind of stocks are you interested in? What sectors? Where do you think the areas for growth are?
So, I still think it's energy. I
Okay.
believe that energy is being underpriced. Here's a beautiful area that is just very hard to study, and it is biotechnology as it relates to using artificial intelligence to build new machineries or new medicines or new um, uh, what's the thing where new regimes that you can go through for therapy
Right.
to
Okay.
get better if you have an illness that's associated with XYZ genome. And you can go in there and they can go, hey, you know what? We can screen for that, and we can send a couple of bots in there and snip whatever, who knows?
Yeah.
Add a protein in there. And so just last week, Jensen Huang came out and said that they were devising a chip for the healthcare industry, not only for them to take care of their patients, but to devise new ways and forms of treatment for high impact diseases. So I am beginning to do the study into these small types of companies. The problem is I can't tell apples from oranges sitting in that
Yeah.
space. So I have to use AI a lot to go, hey, tell me this versus this, tell me this versus this. And then I tell you what I would stay away from is I'd be very careful to buy any software as a service unless it's come in very cheaply. Then you can go look for it, because now, listen, I want to make little video clips of things that I do. And so I'm looking around, and there's this thing called Opus Clip or Opus whatever, and they charge you a monthly fee. And I'm like, that's like the 50th thing they're asking for a monthly fee. Let me go to Gemini and see what I can do. Gemini said, hey, listen, I can build that for you. And it sat there and built it. It said, listen, anytime you want to do that, put this script in first and then pop your video underneath and we'll get it done for you.
Cool.
So
would you say Gemini is your favorite AI flavor?
It's my favorite for research.
Okay.
It is not my favorite for coding. I like ChatGPT, and here's the thing about Claude. Claude's great, except Claude is a hog. He charges so much for tokens. I run out of tokens every month with Claude. Every single month. He's like, sorry, honey. Either you pay $200 a month or you're toast. I'm like, I am not doing, but he's a hog. And so I'll do the work in chat. And then when I get to the more elevated stuff, I'm going to go over there. I'm getting ready to try Fable this week. We'll see how it goes. That's the Mythos one that got released today. Mythos is not out yet, but we'll see.
Tell me if you like it.
I will.
We talked a little bit about energy and grid demand, and you talked a little bit about energy cost and energy being your favorite.
Yeah.
Last time we talked, you talked about P-bottom energy because AI data centers are going to step on the neck of the power grid. Your words, not mine.
Yes. Yes. I would never think you would say step on the neck of anybody. That was definitely me.
No, I'd figure out a different way to word it in a creative manner. Right?
Absolutely. I'm a little savage.
Do you think that AI strain has started to manifest? How is that showing? Etc.
Okay, so short answer, yes, but it's a slow ramp up, right? There's so much spend being put into the centers, and the centers take so long to build because of the traditional building structures that we go through. We don't do any automated buildings for great big buildings. It's still steel girders and everything. And so someone put out an article that said, hey, listen, these data centers are not going to be open for 3 years. Who's to say that the chips that we're running 3 years from now are even going to be required for what's going on in this space? And so we have two fat tails coming into the energy space. One, we're going to have more energy to drive AI. Right now, all of our chatbots and things like that are essentially free. Well, I mean, $20 a month or whatever, but they're very inexpensive. They are losing money hand over fist because of the energy that requires, the compute power that it requires for them to belt out our answers. At some point, we're going to get so dependent on them, they're going to come to us and they're going to be just like the drug dealer down the street going, you know what, that first one was free.
Right.
Now
you want that edit now, or do you want it later? Yeah.
Sorry. So, yeah, I think there's still an impending rubber meets the road event. We can't do that without physical commodities. That's the next thing.
Mm-hmm.
You know, helium, copper, lithium, aluminum, all of the things that we use to build hard things are going to be very important. For instance, gold is fading, right? Gold's been doing pretty badly. It's run off and come down, but
definitely a different story than when we looked at it in January.
Exactly.
For sure.
And so my thought was, listen, this thing is going to fade. And I called 4,100 as the floor, but it lost it. And now I think it's trying to claw its way back. Yeah, it is. I mean, wow, it's up $100 from this morning. Yeah. So that's a pretty big deal for this one. I think, you know, broad sovereign nations are still selling gold to pay bills.
Talking about gold, commodities in general. Last time you also predicted the edge of commodities was coming.
Yes.
We talked about Bill Gates and his accumulation of farmland. Do you still feel like we're there?
Oh, we are right in the throes of it. On top of that, we've got these grand solar minimums, which is supposed to give us a very strong El Nino. Yeah, I think it's El Nino, not La Nina. A very strong El Nino. That's going to make the top of the United States unseasonably warm and the bottom of the United States unseasonably cool. We've had earthquake, volcanoes erupting. All of these things happen on a global solar minimum. But what it does is change the amount of sunlight that gets filtered. It affects crops. And then on top of that, we've got, you know, big rains, all of these things. You're going to see food really start getting tremendously expensive.
It sounds like inflation's not going anywhere.
I don't believe it is.
Are you playing with any commodity markets? Do you buy grains or wheat or coffee or anything like that?
You know, I have a few friends that trade those, but they're so specialized and they know, the people that trade those know so much about what's going on that I almost feel like I'm in a room where everybody has secrets and I don't. And so
you don't want to pay another $78,000 tuition.
Yeah, exactly.
Okay,
exactly. Sure. No more fees for transactions. So I would say I trade nat gas, I trade gasoline, I trade oil, gold, silver, copper, sometimes. But,
are you trading them as the commodities, or do you play with them as the
futures?
Futures, okay.
Futures, yeah.
Yeah, commodities, I guess, is the wrong word. Futures.
Yeah.
All right.
Yeah.
Cool. Well, let's go ahead and do this. I'm going to go ahead and put this back up here. Anne-Marie, it's always such a great to have you.
You are such a good interviewer. You're such a good interviewer. You asked really great questions.
Well, thank you. I get some help from my friend Jemmy.
Well, is Jimmy real? Oh,
yeah. We're on a first name basis now.
I was thinking about renaming my AIs, but I don't want. Have you heard of this AI psychosis?
Yes, I have. I'm actively avoiding it.
Yes, same. So,
and I think there's like some. Oh, anyway, it gets a little bit beyond the point, but it does feel like sometimes they try, like the AI tries to flat. Well, that was great. What you just did was awesome. You get a lot of that from AI.
Oh, I know. In the personalization event, I told it, please do not compliment me to encourage me. I do not need that. You're simply doing some tasks. I'm your taskmaster. Let's just treat it as such. And it will change for you. So it doesn't, but some people like that feeling of, oh, it's great. I just want to make sure, hey, listen, don't start getting any feelings for this Gemini thing or this chat. It is.
I'm going to go in and ask it to give me more compliments.
Yeah, you should. See what happens. You should. See what happens. You know what else you should ask? You should say, if I were a fictional character from television or film, based on what you know about me and the questions that I ask, who would you say that I was?
Okay.
I did that last year.
That sounds
fun.
It told me? What did it tell you?
It told me.
Was it a Disney princess? A Disney princess?
No.
Okay.
It told me I was Amanda Priestley.
Oh, I did. Okay.
But
I don't know who that is.
Oh, she's from The Devil Wears Prada.
Oh, okay.
She's the Meryl Streep character. Only it said, but you're not cruel. So I was like, oh, that's because I don't talk to you like another person. I don't go, hey, blah, blah, blah. I'm like, get this for me, get that for me, get this for me. Okay, goodbye.
Yes, you don't know me yet. That's what you said.
Yeah.
At Anne Marie Trades, thetradingbook.com. It's always a pleasure, Anne Marie. Thank you so much.
Same. I'm sorry you have to clip some of those things that I said.
No. I'm sorry. They're all going on the internet.
Thanks so much. Good luck, everybody.
Thank you.
Take care.